and we have with us the management of JSW Steel. The case for a chat here being that the domestic market is really moving from glut to tightness. There's consolidation happening in the Indian steel sector, and India once again is turning out to be a net importer of steel. Whether or not that's a reality to hold, we will ask that question with Mr. Seshagiri Rao, who's a JMD as well as Group CFO of JSW Steel. Mr. Rao, it's great to have you on the show. Thanks very much for being a part of our 9th year anniversary programming.
My pleasure.
Let me start off with, the top story at hand, which is that JSW is one of the most profitable and efficient steel companies in India. Even during the tide of 2015-2016, you managed to maintain your profitable status. What has aided you, especially at a time where, now there are question marks being raised about the sustainability of this upcycle?
JSW Steel that way has certain unique features. That's why we are able to successfully pass through the cycles. Our conversion cost was the lowest in the world. We have been ranked as number 6 among the 35 top world-class steel companies. On the conversion cost parameters, we have got 10 out of 10. Similarly, our specific investment cost per ton for installing capacity is one of the best in the world. So our capital servicing cost also will be lower, and our product mix is rich. We have almost close to 57 to 60% of our product mix is high-end value-added special products. I think these are the distinguishing features why JSW Steel always remain profitable, notwithstanding the steel cycles.
Morning. Domestic steel prices have continued to remain on an uptrend from November last year to May. What would you attribute this to? Better demand?
Yeah, you must have seen the numbers of April and May of this financial year. The consumption of steel has gone up over 8%. So that means it is 1.2 times almost of GDP, which indicates that the investment cycle is coming back. Whatever slack that is there in various user industries, including steel, that slack is going away. The capacity utilization has improved substantially. So demand from the user industries, I think, is quite strong. That is the underlying feature which is getting reflected by a very strong consumption growth. The consumption growth, if you see in the last year, in the first 2 quarters of last financial year, which used to be 50% of the GDP growth. So it was 3 to 4%. It started accelerating in the last 2 quarters of the last financial year. Now that is picking up momentum. So in these 2 months of the current financial year, we have seen close to 8.5% consumption growth. It is also relevant to note that the exports are falling. Exports in the first 2 months of this year have fallen by 15%, whereas imports are growing. That is also one of the important thing which we have to note, because of the trade tensions across the world. Imports are increasing into India. But what is heartening to note is that the demand is quite strong in India.
No, so with India's surging demand after 5 years of lackluster outlook, do you think that the country has the necessary drivers and triggers to do even better in FY 19 and 20, that this uptrend in the cycle can continue?
Whatever demand momentum we are seeing from the user industries, either you take automobiles or you take infrastructure, or you take piping industry, or you take fastener industry, component sector, capital goods, I think there is a broad-based momentum in the demand which we are seeing. But at the same time, we should be watchful about the global developments, the trade tensions and the liquidity constraints which are there both in India and also globally. So taking that into account, we should be watchful of these events. Otherwise, I think growth momentum, underlying growth momentum is quite strong.
US prices have surged to about $800 to $900 per ton, Mr. Rao, on account of Trump's tariffs. What's the impact that you've seen given your own operations in the US? And, as an extension to that question, if you could just throw more light on what your own understanding is of these trade war tensions impacting the commodities industry, especially steel?
As far as the trade in the steel industry globally is concerned, it is around 400 million tons. Out of 400 million tons, US imports were 37 million tons. At the same time, Europe also imports steel from various countries. So, because of the trade tensions and the various actions by being taken by various countries, there could be some steel which look for markets. That is expected to be, in our view, if EU also introduces from 1st of July some safeguard duties on imports in retaliation with what US has done, then the exports which are happening from export dependent countries, either Japan, Korea, Russia, China, that steel look for new markets. So, that can create issue unless other countries like India, where demand is quite strong, if we are not watchful about imports, imports are growing into India, exports are falling because of the trade tensions even from India. I think that is one concern which can create some dent in the overall very positive global steel demand outlook that I think we should be watchful of.
Mr. Rao, the one grouse that you have always had has always been when it comes to domestic operations and the high pricing of iron ore, especially in the state of Karnataka. What are you contending there, and has that prompted you to refrain from bidding for iron ore at the state e-auctions?
No, it is very unfortunate in India. Where we have a natural resource like iron ore, which is a key ingredient for steel making. Several companies after liberalization, including JSW Steel, which had invested very large sums in the steel sector for creating value to the iron ore. In the pre-amendment of MMDR Act, we could not get any iron ore mines. Not only we, whichever companies that have been set up after 1991 liberalization, they could not get any iron ore mines allocation because of either litigations or because of various other factors. So, even after the amendment to the MMDR Act, the auction of iron ore mines are not happening at the pace the steel industry requires iron ore. So, the user industries really are suffering, particularly if you look at Karnataka, there is a ceiling imposed by the Honorable Supreme Court. Even though it is relaxed very recently to 35 million tons, there is a relative shortage of iron ore over demand. So, that is the big problem, due to which the steel companies are forced to buy iron ore in the e-auctions at any price. The mining companies, particularly NMDC, they used to fix the base price in the e-auctions higher than what is prevailing across India. Particularly for low grade, high alumina, high silica, high moisture. So, these are the grades of iron ore. So, generally the iron ore that is available in Karnataka is low grade, but commands highest premium, unfortunately because of the this shortage of iron ore in Karnataka. So, this situation has been continuing since 2013 after the mining ban is lifted and the mining companies are allowed to sell the iron ore in the e-auctions, but the steel companies had no option except buying this iron ore at significantly at a very high high prices. Adding to that, they started introducing, particularly NMDC, the differential pricing in Karnataka over Chhattisgarh. Number one, if iron ore is available, let us say at 900 rupees per ton for 59.5% grade in the state of Orissa, for steel companies located within Orissa, this 900 rupees is loaded into wagon including taxes. For a similar grade of iron ore, if steel companies located in Karnataka had to pay 3,306 rupees per ton, it is X mines I am talking, then it is almost 2,200 rupees, 2,300 rupees more than what is prevailing in Karnataka. every ton of steel requires 1.8 tons of iron ore. Then if we have to be competitive when we have to sell in the market, sourcing iron ore at 2,300 rupees higher than what is prevailing in Orissa, then we are at a disadvantage overall. I think this is what we have been articulating in every forum, that the iron ore prices, if it is controlled in Karnataka, not controlled in the sense at least monitored, because the supply is controlled in Karnataka, otherwise the steel industry has to suffer. This is what I think the entire steel industry in Karnataka has been articulating for several years. This is the problem.
Outlining that for the benefit of our viewers, Mr. Rao, you've also won the bid for Monith Ispat. How soon before you can put life back into its facilities, get it up and going at its optimum capacity, and in general turn the operations around, complete full integration?
So as we informed earlier, we are one of the we are the successful bidders in the case of Monith, along with our consortium member Iron Capital. The resolution plan is yet to be approved. It is in the pending in NCLT. So once approval comes, I think we will be able to immediately start implementing the resolution plan. So it may not be appropriate at this stage to talk about what are our plans unless our resolution plan is approved and we complete the process of taking over the company.
Mr. Rao, such a pleasure having you on the show today. We would have loved to chat a little bit more, but commercial obligations have to take a commercial break now.
Thank you.
Okay, that's the word then coming in from Mr. Seshagiri Rao.